back to the Exit Teams podcast, where business owners and their advisors get real practical insight on how to build a team of advisors, maximize value, and exit on their own terms. I'm your host, Bob Tankesley, author of Exit Teams, Build a Team of Advisors for Your Business Sale to Get a Higher Price. You can find that book and all kinds of content at exitteams.com. You can order that book off Amazon. Whether you're years away from selling or thinking about an exit now, this episode, I assure you, will be packed with must-know tips to help you avoid costly mistakes while taking advantage of opportunities. Today, I'm joined by an expert in the world of business buying. Yes, you heard that right, business acquisitions, because we often talk about exit here on the show from the standpoint of the seller. An expert in the world of business buying, David C. Barnett. David is an international speaker, author, consultant, and authority on buying, selling, financing, and managing small and medium-sized businesses. He has more than 25 years of experience across entrepreneurship, finance, business brokerage, lending, valuation, and education. David has owned and sold businesses, his own businesses. He has arranged commercial financing for hundreds of companies, facilitated more than 35 businesses buy, sell, and transactions as a broker, and has since consulted with hundreds of companies and earned both the CBI and CMEA designations. He later managed American Express's corporate mid-market credit programs in the Atlantic Canada before focusing on advising, teaching, and writing. He has written 10 books, including How to Sell My Own Business and 21 Stupid Things People Do When Trying to Buy a Business. And he has created the Business Buyer Advantage program, which we're going to dig into here on the show. His YouTube channel and podcast have reached a global audience with practical guidance on buying, building, financing, and exiting businesses. David, welcome to the show. I'm really glad to have you on because you're going to bring that voice of the buyer to this episode for so many people watching or listening.
Well, thanks for having me on. I always love the opportunity to get out and talk to people and share perspectives and ideas to make people think a little bit maybe about what this might look like, the whole procedure and the project of actually selling a business, because it certainly is a complicated thing and it takes a lot of work to get through.
Very complicated. If so, for anybody watching or listening who wants to buy a business, this should be a great episode. So let's dive in. David, from the top, let's start talking about seller expectations versus market reality, right? You've sold companies, I sold companies, and often in our role, we like to try to dispel a lot of misconceptions before we take a company to market, take on a project that might last 100, 150, 200 hours. I know that most owners I've come across, they carry some kind of private number in their head. They don't share it with too many people, but long before they ever test the market. The market usually sees the business, though, through the lens of buyer risk and cash flow, how deals get financed, and whether the thing is even transferable or not. So, my first question, right off the top, where do you see small business owners most often misunderstand what their business is actually worth?
Yeah. So I think the easiest thing is that many small business owners think that this thing called goodwill is something you can point at and quantify independent of everything else that might be in their business.
Thank
And
you.
that's not the case. That's not the
Yep.
case at all. That goodwill can only be measured indirectly. So we look at the cash flow of the business and determine what someone would realistically invest to acquire the cash flow under the assumption that it will continue after they become the owner. And then we can look at the tangible assets within the business. And the difference there is the goodwill. And so I run into sellers all the time who will have a story about how long their business has been open, how it's a multi-generational business, or how they've got this great brand or this amazing logo or whatever. And they'll try to ascribe some kind of value to this brand presence, market presence. And they'll say, this is what my goodwill is worth. And then they'll start to add everything else that might be there in the shop with them. And they'll add it all on top, and they'll think somehow that this is a reasonable way to put a price on a business. And it's just a fundamental misunderstanding of how an investor or business buyer is going to see their business, because most buyers, and I deal largely in the Main Street and lower mid market space, most buyers they actually have two hats on at the same time when they acquire a business. They're making an investment, but they're also acquiring a job because often they're going to come in and take over the role day to day that the current owner is doing. And so both of those points of view are important when they're making that decision about whether or not to get into a deal.
Couldn't agree more. I'm glad you hit goodwill right off the top. Um, Very rarely do we see it on a balance sheet unless they bought another company and they're
Hmm.
amortizing, that goodwill over time. But helping an owner understand that goodwill is, from an accounting standpoint, is the purchase price over and above, the purchased assets that the buyer is actually acquiring, and that you get to write off over time. But often the value of the business as classically determined is already accounting for goodwill. It's not some additional magic number that you get to pull up, from the air and drop on top of a multiple of EBITDA.
Yeah.
Yeah. I know a lot of sellers also compare their business to the headlines that they see from much larger transactions. But let's face it, Main Street and lower middle market deals, they operate by very, very different rules. I mean, risk is entirely different between those two different ends of the spectrum. So, in terms of valuation myths, what do you see owners bringing into the sale process that creates problems later?
Well, the when people value the stock of Coca-Cola, like if someone, Warren Buffett wants to make an investment, he wants to buy more stock in Coca-Cola. When he buys those shares, he is concerned about the performance and the future opportunities of Coca-Cola. And when he buys those shares, not only does he get the plants, the trucks, the people that make the deliveries and all that kind of stuff, he's also getting the complete leadership team that created the plan for the next 5 years. And so he is able to look at the future performance of that business, and he's able to make a decision about what he's willing to pay for that stock based on what he thinks will happen over the next few years for Coca-Cola. When people buy a privately controlled business, they are not concerned about the future in the valuation question. The future is important about whether or not they want to actually do the deal. If they don't think the future is good for the business, they're not going to buy it, obviously. But they're not going to put any kind of value on what they're going to pay a seller based on what the future will hold, because the seller will be gone. And this is the big difference: is the leadership and direction of a private company departs when the business is sold, and the buyer is the one that steps in and takes over that role. So why would a buyer pay a seller for any kind of value for the future if it's in fact the buyer who has to come in and actually lead and do the work to make that future happen? And so this is where there's a giant departure between what you see in headlines versus what really happens in the world of small business deals, because the basically the value of what you build is entirely going to stand on your track record. And then it can only really be sold if the buyer believes that that path or that profitability is going to continue once they become the owners.
It kind of sounds like we're talking about the way buyers think and whether a deal is even feasible or not
Hmm.
for them to step in and be the new owner. And as a sidebar, I often find, I'm sure you do too, buyers are very concerned about what happens to the business if something happens to the owner. They're trying to figure that out and get an answer to that question within certainly the first, two or three, four conversations. They dig in deep. At least sophisticated buyers do. Maybe buyers that have gone through your program have received, similar kinds of training. They've got to figure out how much of a system is left, how much of company-wide knowledge, how much of what is needed to run this business is left behind when that owner steps out.
Yes, and what is important in that conversation is understanding whether your business is similar to other businesses. So, there are a couple of different varieties of business. Well, let's put labels on two of them. There is the type of business which generally operates very similar to many of its peers. So if you own a roofing company and you go put new shingles on people's roofs, like, you're operating pretty similar to a lot of other roofing companies out there. And so if somebody knows this trade, they have a pretty good idea of how your business is going to run. And maybe you've got some different processes or something that you're going to be able to teach them. But if you are something that is completely unique based upon your own experience and inventiveness, and you've come up with something entirely new and you've really cornered a niche and it's made you very, very profitable, everyone's going to be suspicious that you have some kind of secret sauce knowledge in your head that isn't properly documented. And so the further away you get from that sort of plain Jane vanilla, everyone knows how to run this kind of business sort of category to the other extreme, it becomes a bigger and bigger job to convince the buyer that they're going to be able to operate the business. And this is why corner stores and Subway restaurants and many of these cookie cutter type of businesses sell very quickly to people maybe who really do already know how to run them because of their past experience in other businesses in that field. And these things trade really quickly with a lot of buyer competition and a lot of you know basically there's a more fluid market, I guess is what I'm trying to describe for those cookie cutter businesses. The more interesting, let's say, that you become, and the more distinguished, maybe the better your competitive moat might be, the better your margins could be. All the good things in business that make you a better, more profitable business are also going to create challenges for you convincing the buyer that they will be able to carry on and run the business the same way you do. It's it to me that's a challenge I point out oftentimes to people who built really great businesses, ironically.
And two, you have some conversations with them around, okay, what is protected? Protected by contracts, protected by, some type of intellectual property uh, rights and restrictions. Key employees, are you protected as an owner from them leaving? I bet you spend some time around, hey, you got this, what you think is a secret sauce, but not only is it not well documented, but you're wildly exposed here in all these areas where your advantage can get out away from you.
Yeah, and I mean the biggest problem or issue I think in the world of small business is something that one of my clients describes as bench strength. So if you think of a big public company with hundreds or thousands of employees, there chances are somebody else in the business has done a particular job, and if someone just disappears one day and they don't show up for work, their role can be filled in to some degree by other people kind of pitching in, or people
Yeah.
who know how to do the job, covering for a while till they can be rehired. But in the world of small and medium sized businesses, we often don't have the depth of uh, people in the business to cover every role in that kind of backup fashion. And the further up the pyramid of leadership you go, the thinner the bench becomes. Your frontline employees may be able to back each other up. Your supervisors may be able to back each other up. But you know, I know a business that does tens of millions of dollars of revenue. It is a good sized business, and they're in the construction management field. And they had their CFO and COO both resign within a 6 month period.
Oh,
And that created a huge crisis for that business because the president and the owner had stepped out of day-to-day operations. Well, the owner had to come back in, and the owner actually became the COO. And now the president and the owner are trying to keep the ship going while they recruit for a CFO and a new COO at the same time, while they've got all these projects going on that are all mission critical. And that's an example of what I mean by a lack of bench depth. And all small businesses suffer from this, especially when you get up to the leadership echelon of the organization.
yeah. I've noticed over the years, buyers are not just asking, hey, do I like this business at all? They're also asking whether the cash flow, and as you just, gave an example of the risk, in this case, the risk of a mass exodus of upper management. Buyers are asking questions about financing and the transition plan with them stepping in and the owner stepping out. How do serious buyers actually evaluate whether a small business is worth buying? So, business owners, if you're thinking about selling someday, now's the time to pay attention.
Yeah, so it comes down to this. It has to make sense from a financial point of view in that the business has to demonstrate enough cash flow to cover the debt service that the buyer is going to have. And one of the things that sellers don't often get is they don't quite understand that the business you sell is very different from the one that the buyer receives, because the buyer is often going to leverage it up with debt. They're going to have to borrow money in order to do the transaction. And so, I will have sellers that I meet who will say, I heard businesses in my industry are going for this multiple of cash flow. And
Yep.
they throw out a number. And then I'll ask them a question. I'll say, well, who typically is going to be buying your business? Are they going to be somebody from your trade? So in the world of hospitality, let's say a restaurant, one group of people that comes up and buys a lot of restaurants are people that work in restaurants, right? So the chef or the front of house manager at a restaurant gets years of business experience under their belt and they decide, I want to own my own place. They go out into the world of buying a business and they make an offer on a restaurant. Now they've just come from working in a restaurant. So do you think they'll have a big down payment? I mean, they're coming from a low wage environment,
They
right?
might be
And
struggling to make an SBA down payment
well,
on an SBA loan.
precisely. So I walk people through this, and I say to them like let's imagine who realistically is going to be the person that buys your business. And every time you read an article online, it talks about private equity and ESOPs and all these fancy ways to get out of your business, and it's all nonsense for the most part. The number one biggest buyer of small businesses is an individual person that is wanting to own their own business. And that person is usually going to be somebody who has some degree of knowledge of the industry that you're in. So if you're selling an HVAC business, it could very well be someone who's coming out of an HVAC business. It could be a manager of somebody else's HVAC business right now, and they want to buy their own, for example. So who is that buyer? How much money are they likely to have? Are they going to have the right experience to satisfy the bank as far as the bank's requirements for expertise and being able to run the business and knowledgeable about the industry? And what sort of down payment do you expect them to have? Because then you can actually ask yourself, what will their debt service be? And you can start to walk through the process of buying your business through the eyes of this buyer, and what's their down payment, what is their loan going to be, how much is their debt service going to be, and then you can look at your own cash flow. And a lot of the times when I take sellers through this, they are surprised to see how all of the cash ends up disappearing and how tight it is for most buyers to actually get into these deals. And they don't actually have any degree of real, cash flow from a look at me, I'm doing well kind of point of view until after they've paid off those loans, which could take them 10 years into the future. And we know that small business is risky. So a lot of these buyers are really gambling that they're going to be able to manage the business and the market's going to hold up and everything's going to be great for a decade.
Yep.
And this is really a bit of an optimist's stretch because a normal business cycle, and I know we haven't seen this in a while, but a normal business cycle sees a recession every 10 years, which means that when that buyer signs that SBA note for a 10-year loan, they are almost certainly going to be going through a recession at some point during the debt service of that
That
loan.
should be modeled. That should be dealt with and known ahead of time and planned for.
Right. And so a lot of sellers though, when they start to hear about what businesses are being sold for, they hear the multiple, they apply it to their own business, they think about how much money that's going to be, then they start spending the money in their head. They
They get
say, I'm going to
happy
buy the
years. Yep.
RV, I'm going to
Yep.
buy the condo, I'm going to like go on the big trip or whatever. They never get beyond that. They never actually think about what it's going to look like from the buyer's point of view. And I've had situations before where sellers have been trying to sell their business for a couple of years, and then they'll find my content on YouTube, for example, and they'll reach out to me and they'll say, hey, can you help me? I don't know why my business isn't selling. And I'll go through the sim or the business profile that the broker maybe has put together. And I'll just walk them through it in this way. I'll say, look, who's your buyer going to be? And I'll show them that there's number one, there's usually no way that the business could ever be sold for the amount they're asking. And number two, if the buyer is going to make it work, it often is going to require some degree of participation from the seller, which they don't like to hear either. And
That's right.
and really, in a lot of those cases, it's that the intermediary that the seller's been working with has not accurately set the expectation for the seller. Um, and I've noticed this in a lot of markets, particularly like if you think about geographically based businesses with local business brokers, and if the business brokers are competing to get listings, there's a real incentive to inflate the expectations of business owners in order to secure the listing. And then you work later as the business broker to try to knock them down to something realistic, which doesn't serve the interests of business owners at all to have your expectations inflated and then have to go and deflate yourself. I've found that when people really believe that their business is going to sell for $2 million, and then a year later they discover their business is really only worth 1.2 million, they actually have to go through a mourning process to mourn the loss of the 800 grand they thought they were going to get, which it turns out they're not going to get because it was never realistic. But in their mind, they had the money. And this is what causes a lot of sellers to get stuck on these expected values and not be willing to adjust themselves or listen to the signals that the market is giving them.
Meanwhile, the industry turns, their health suffers, they get divorced,
Yeah.
life happens. And you're probably familiar with this stat. You probably heard it before too. Roughly 20% of companies are ever taken to market, and roughly 20% of those ever transact. If you're only listening, you can't see me. I'm holding up four fingers. That ends up being 4% of companies ever transact. Now, granted, that's more toward the smaller end of the company size spectrum, but the stats are really dismal, and I wholeheartedly agree. I place a fair amount of the responsibility on the advisors, the M&A advisors and the brokers to the owners of businesses not setting realistic expectations early.
Well, one of the assumptions that people make all the time is they think that they are going to be able to sell their business whenever they want to. And
Yes,
I've got a there's a guy named Mike Finger who likes to talk about this all the time. He's an exit coach for business owners. But the reality is, as Mike says, is that businesses don't sell when the owner wants to. Businesses sell when they're ready to be transferred. And so they have to be prepared and they have to be in that right state where the buyer is going to say, yeah, I think I can take this over and I think everything's in place here for me to run it. And so people with this idea that they can sell it whenever they want, they kind of think of it like it's any other sort of investment in their portfolio, that when the mood moves them, they'll be able to put it up for sale and they'll be able to turn it into cash. It is extremely complicated to sell a small business. Not only do you have to present it properly so that the right buyer who comes along at the right time is going to be attracted to it and that they are going to have all of the resources they need to actually do a deal. You have to have those things magically come together, and then you have to actually get through all of the due diligence and all of the expectations of all of the advisors of both parties on either side. And as a former business broker, I can tell you there were many, many, many times when the buyer and seller both agreed to do a deal, and then something one of their advisors said completely upset the apple cart, and the deal would fall apart. And then I would have to go back to the drawing board. There was my last deal when I closed my business brokerage office in 2011 was one of my first listings at the end of 2008. I had that file on my desk for 3 years. I sold the business three times. The first two times I sold the business at the 11th hour before closing, the deal fell apart because of something that came up. And the final time, miraculously, it went through. So that and that's just an insight into how crappy it can be to be a business broker sometimes. But these are complicated, challenging transactions. And because small businesses tend to sell for lower multiples than any other kind of investment because of the risks we're talking about, there is never an incentive for anybody to cash out. You asked me a question earlier about big public companies. Mark Zuckerberg has an incentive to cash out of his Facebook stock. Like, I mean, he started the company, his cost basis is zero or whatever, and the shares are worth $1 gazillion. In small business, when you tell someone what their business is likely going to sell for, they usually are disappointed. And
I find
so
about three out of four times if I deliver a valuation report or an estimate, yeah, it doesn't meet expectations. Three out of four times.
yeah, and that is my experience as well. I would say for me, maybe it's 4 out of 5 times people are disappointed.
Yeah.
And so there is never a cash out motivation for selling a business. People sell businesses when they have a personal motivation. And there's five of those. There's the mental bucket, burnout, boredom, and fatigue. Then there's divorce, poor health, the need to relocate, and then finally retirement. Retirement is the only one that is planned for. And, you know, if you ever wonder why there are so many 75 or 80-year-old business owners out there, a lot of it has to do with the fact that people assume that they're going to be able to sell their business for a certain amount of money and this is going to fund their retirement. And then they learn far too late that that's not going to happen or it's not going to yield enough to fund their retirement. And they end up staying in the business because that's what is providing them with income. And so for people that, want to ensure that they are going to have a way out and they're going to be able to retire and have a happy ending to their business ownership career, my number one piece of advice is actually make sure you're pulling profits out of your business and building an independent wealth outside of your business that is sufficient for you to retire on. Because if you can do that, two things are going to happen. Number one, you don't become dependent upon a transaction to retire. And number two, You create a track record of a profitable business that can demonstrate money coming out of it into your pocket, which ultimately proves the value of the enterprise.
Which lenders love to see, whether backed by SBA or not. Yeah.
Yeah, yeah. This whole idea of reinvesting everything in the business. I mean, like, you when you go to sell your business, people are going to want to know where's the profit and show me you took it. And if you've got 101 stories about how you took any extra money and put it into something else that was supposed to yield some kind of result and it didn't work, like one of the craziest things I see in this world is when people try to do ad backs for strategies in their business that didn't work. Like adding back the cost of some kind of ad campaign that didn't yield any customers. Like, making mistakes with how you spend your ad money is something that happens in business. It's just a normal part of being a business operator. You don't get to add that back just because you want to inflate your business value.
On the personal perk side, I'm sure you've seen it as well. I've seen just about everything: the boat, the plane, the multiple cars, the vacation home, the kids' college. A lot of stuff gets run through a small business.
Oh, all the
Hey,
time. Yeah,
yeah. To extend this topic that we're on, talking about financing a little further, let's get into the area of seller financing and deal
sure.
structure. Seller financing is, as you mentioned a couple minutes ago, it's often one of the more important tools in a small business transaction, whether or not a bank's involved. But many owners resist it, or they misunderstand what it signals. Now that's an interesting statement. Why is seller financing so common in small business transactions? And follow-up question: what does it communicate to a buyer or a lender?
Sure. So when you buy something like a house, you want to make sure you know what you're buying. So you get the home inspection guy to come over. And he looks for cracks in the foundation. He checks out the chimney, and he's got the special meter that looks for moisture in the wall. And when he's done his report, he can pretty much tell you the state of the house and what work might be required coming down the road. And between the time he inspects it and the closing day, the house doesn't change much unless it gets struck by lightning, right? So you can do your due diligence to a pretty good degree on something like a house.
Yep.
In a business, you've got 101 moving parts, right? You've got receivables and payables changing every day. You've got inventory turning over every day. You've got new deliveries arriving. You've got somebody shoplifting in the front. You got the shipper receiver guy with the drinking problem making mistakes. Like so many things are moving in this business all the time. If you are a big enough business and you've got all of the management systems, protocols, etc., that a Fortune 100 company has, then somebody with enough money and resources can do a complete due diligence on your business and understand everything that's going on in it. And that's what happens in the world of public company M&A. In the world of Main Street and lower middle market, those systems just don't exist. There's no way for a buyer to ever be able to do an absolute thorough due diligence on a small business.
They've
So
only
if it's
got
in,
on average 60 to 90 days of due diligence. They've got to learn within that short period of time as much as they can that the seller knows and has known over their entire ownership of that business.
that's right. And there's no way to do that. So what ends up happening is you get this list of prioritized things where people are saying, here's the number one priority in due diligence, here's the number two, here's the number three, number four. And if we can get through the first good chunk of them with a good degree of confidence and things turns out the way that we want, then we'll probably go through with this transaction. However, item 55 that we don't have time to get to is could still come and get us.
Hmm.
And so the way that you get around that as a buyer is you need to create some kind of method that keeps the seller on the hook if it turns out they're lying to you, right? The number one fear that business buyers have is that the sellers are cheating them through a con artist kind of maneuver.
I'd agree with that.
So
Yeah.
so
What
so
what
the
what do they know that they're not sharing before
yeah.
closing? Yep.
So this is why you get sellers disclosure statements with open-ended questions. This is why you get the due diligence period. And what the seller note does, if it's
Reps
the
and
deal,
warranties on the back end.
yep, all of this stuff basically is to hold the seller accountable. Now, Bob, if I bought your business, even with all what we had all the reps and warranties and the seller's disclosure and all that kind of stuff, if I paid you cash for the business and it turned out 3 months later I discovered you lied to me, My only recourse would be to hire a lawyer and try to sue you and try to get some of that money back. And I would be subject then to the whole legal proceeding and maybe get years of my life tied up in court. Meanwhile, the business might be failing because of what you lied to me about. But if I buy the business and make you hold a 30% seller note, subject to offset in the case of material misrepresentations, what that means is that when I discover that you'd lied to me, I could simply say to you, you lied to me about this. I'm damaged to this amount. I'm deducting that from what I owe you. And what that does is it now gives the buyer power over the absolute outcome of the deal after the closing day. And it creates a scenario where if you want to get all of your money, you have to be honest and forthright with me. And you also then have an interest in me being successful with the business. So you want to do a good job in the training and transition, and you want to offer coaching advice to me, and you want to be there to answer my phone call when I have a question about the biggest customer and why do they want it done this way, and did you ever deal with this problem before? And you're eager to help me with that because you want me to have success. And understanding as a buyer that I put the seller in a position where they need me to be successful in order for them to get their money means that I now know that I have a degree of leverage in this transaction, which balances the fact that I don't know everything. So the seller has ultimate knowledge of what's going on in the business because they've lived in the business for so long. That creates a
Yes.
power imbalance between the two parties. The seller note rebalances the relationship and puts them both on an eye to eye basis where I describe it as a temporary partnership because during the time of the seller note payments, again, the buyer wants to succeed. They put their down payment money in. They've got a note they signed and personally guaranteed at the bank, and they want this business to succeed. The seller needs the buyer to succeed. So both of them have the same goal and interest. They're aligned. So that's why I call it a temporary partnership. Once the last seller note payment's been made, then the seller can just go off and do whatever they want. Then by that point, years have gone by, and now the buyer's an expert in running the business anyway, right? Now they've had a chance to acclimatize themselves. When when a seller says, I refuse to do seller financing, here's what the buyer hears. The buyer hears that you as a seller don't believe that they can run the business, number one. Or number two, you know you're lying about something important to them. Or number three, you know there's a problem in the marketplace for some reason. Or number four, you know there's a problem in the business. Like you know that the shipper receiver who has a drinking problem ran somebody over and you haven't told the guy, right? It's going to be bad. So all of those scenarios, either the lies, the omissions, the lack of confidence, all of those reasons are great reasons not to do the deal from the buyer's point of view. So when I teach buyers how to buy a business, I let them know if a seller refuses to do seller financing, it is the number one sign that there's something wrong in the deal. And it's interesting when I talk to bankers, because when bankers look at deals, they want to make a loan, they want to be repaid. When they see that a seller is willing to finance part of the deal, it gives them confidence in the deal because they understand that the seller understands the business and the marketplace and everything. And that if the seller has the confidence to do a seller note, it often gives the banker the confidence to make the loan. Now, here's a problem that is specific to the United States. The SBA loan program creates some problems in the market, and here's what they are. The SBA loan program creates a huge amount of leverage opportunity for buyers, up to 90% financing in some cases, with up as low as 5% down payment. And it skews the market because whether you borrow 60% of the price from the SBA, from a bank under the SBA program or 90%, it's the same interest rate, which would not happen under any other kind of credit situation, right? Because the 90% loan is riskier than the 60% loan. But the SBA will back these and do it. And so what ends up happening is because of the SBA program, many sellers know that buyers can get these 90% loans. And so they hold out for that, thinking, I'll just wait for somebody to get one of these SBA loans. And they might end up holding a 5% seller note, which in my opinion is not material enough to be able to offset against if any of these problems end up appearing after the transaction. And so it actually creates an incentive for sellers to act dishonestly in some parts of the market to try to get the highest price they can, get the buyer on a hook with one of these high leverage SBA loans, and then take off with the money.
Got a
So,
friend who does turnaround work, and he's he's looking at a tidal wave of SBA problems, SBA related problems coming up. He didn't give it, nor does he know because his crystal ball doesn't work. But he didn't give a time frame. But he said, Bob, it's a large number.
Listen, there are people that point to the SBA loan default rates and say, which are very low, by the way, very few people default on these loans so far in the data. They point to these low default rates and they say, look, small business isn't as risky as people think. I have met dozens and dozens of people who've bought businesses and have made mistakes and have been working for free, never able to withdraw a salary from the business because all the money goes to the bank note.
Yep.
That's not a definition of success in
That
business.
doesn't show up in the statistics. They're not
Exactly.
measuring the owner's decreasing compensation.
Right. It only shows up when things get bad enough that a note payment is missed. And,
Yeah.
and things have to get pretty bad for that to happen. So when I work with buyers, I coach them to make sure they have a material amount of seller financing to make sure that the seller is actually committed to their success. And from a seller's point of view, what does this mean? It means that you actually have to realize you're wearing two different hats when you're selling your business. I mentioned earlier that buyers have two hats on. They have the investor hat and the operator hat on because they're going to come in and run the business. When you're selling a small business, you have to have two hats on as well. You have the seller hat and a banker hat. You have to be looking at this buyer saying, can I trust this person with, $100,000 seller note or a $300,000 seller note or what have you? Are they the right person with the right experience, credential, attitude? Are they coachable? Will they listen to me? You have to pick the right person so that they are going to be successful because, you know, if you insist on cash terms, what's going to happen is buyers are going to think of everything that could go wrong and they're going to want to discount the price to accommodate the risk coming true.
Because now they're the bank. Without an external bank, they become the bank, and so their their risk tolerance goes way down. I've been telling sellers for a long time, you want to optimize your company. You want to get it ready for prime time. You want to stand out among your peers because for two reasons. You want to impress your future buyer so they're willing to pay a
Mhm.
premium, but you also need to be impressing your future buyer's provider of capital, which is often going to be a bank. Sometimes it's an investor plus a bank or just an investor, but at the lower end of the market, it certainly there is some bank financing often involved, and you got to impress them too before, as you go to market.
Yeah, absolutely.
How about earnouts? I've noticed you probably have two earnouts have become as best we can measure it, kind of anecdotally in most cases, a larger percentage of the deal that gets done, and in more and more cases, earnouts are being asked for. Are you seeing buyers not just asking for seller notes, but for earnout terms as well?
Yeah, so there's two great sources of data in this industry. There's the Biz by Sell quarterly report that comes out where they talk about what's happening on their platform, and then there's also the International Business Brokers Association has a quarterly report that they put out too, which asks some questions about the deal structures and things.
Yep.
And for forever and a day on Main Street and in the lower middle market, which we're talking about businesses with a cash flow to their owners or EBITDA, STE up to about $1 million. The multiples didn't change much at all.
Yes.
In the middle market and the bigger ones, the multiples change with different economic conditions. Back in the post-pandemic era when interest rates went down to near zero, those multiples did move because people were borrowing money almost for free. And so some buyers who got excited decided to borrow more and make higher offers and the multiples did move. And the reason why we're seeing more earnouts is because business owners have heard the stories of somebody who got this crazy price that never would normally have ever been
Yep.
a, something that was doable for a buyer, except for the fact that they bought during that period of low inflation. And people who get an SBA loan, by the way, that's a resetting interest rate every 3 months. A lot of those people were in a lot of pain by 2024 when the rates started to really climb. But these people who want to sell, they've heard the stories of people getting the really high prices and they're holding out for these high prices, but the buyers just can't make it pencil no matter what. And so the only accommodation that can happen is that the buyers can say, look, if these extraordinary series of events were to happen and my profitability grows by this incredible amount, then I will give you this last little bit of value. And that's where we're seeing earnouts being used to try to bridge the gap.
Bridge
And
the gap. Yeah.
for the people listening, the difference between a seller note and an earnout is that a seller note is a debt that is documented. I owe you 300 grand. I'm going to pay you this payment every month or every quarter, whatever it is. An earnout is an amount of money due based on future conditions. So, earnouts can be, if I achieve this EBITDA level in 36 months, I'll owe you another 100 grand. But they could also be, I'll give you 1% of sales beyond this certain benchmark that you claim the business should be able to grow to. And if I do grow it to that point, you'll get this extra money. It can be phrased in a number of different ways. If you're in the United States, the way earnouts are used has to be pretty specific if there's an SBA loan involved, because the SBA doesn't allow them. They want a specific purchase price. But the way people do that is through forgivable notes.
Yeah.
So they'll do multiple seller notes, and some of which just get forgiven if these conditions aren't met. But it's the same kind of thing. They're only paid out if certain circumstances come to be. And so, what is that? I'll tell you what I think it is. I think it's an exercise in ego. So if some guy's at the golf course and he hears that someone he knows sold their business for $2 million, well, of course he wants to sell his business for $2 million, and he wants to be able to tell everyone that he sold his business for $2 million. But if his business is only worth 1.6 million, what's he going to do? Well, he can sell it for $2 million with a $400,000 earnout, subject to a bunch of conditions that are unlikely to happen, and he can still tell everyone he sold for $2 million. He doesn't have to explain that he didn't collect the last 400 grand. And for some of the deals that I've seen the documentation for, there's a lot of this going on where people have these aspirational vanity numbers that they're trying to hit. And the only way buyers can actually hit them is by creating these outlandish circumstances.
Yeah. I've noticed, and I hear anecdotally, earnouts are rarely hit, the metrics that earnouts are based on. And so the payout is not 100%. It's in many cases something dramatically less than.
Yeah. And sometimes an earnout can be based on something as simple as the seller staying in the business and remaining active in some role. And this is one of the ways people bridge the problem of transferability. I mentioned earlier, if you have a very special kind of business that people aren't quite sure that they can take over or not, you can expect an offer that will include you sticking around in the business, maybe sometimes for years, to continue to work with the new owners and to create a period of goodwill transference, especially if there's a real connection there between the business owner and the big customers. A buyer might say, "Hey, I want you to be in this business for 3 years' time." I've seen conditions where sellers have actually had to agree to attend industry golf tournaments for 5 years after the deal was done, because everyone in the industry goes to this one
He was
golf
that
tournament.
instrumental. Yeah.
And they say, we need you there every year, and I'll slip a credit card in your pocket so you can buy people beers and stuff. But we want you there because you've always been the face of this business, and we want you hand in hand with our new president showing everybody that you have full confidence in us and we can run this business, and people should trust us like they trusted you. And for sellers, sometimes it's a bit of a shock, because again, they think it's an asset, like some kind of investment account asset where they think they can just sell it, and sometimes it's not that easy.
I think another shock that sellers should be prepared for is rarely are they receiving full compensation for the years that they're being asked to stay on. I've never seen it where it's no compensation, but it's often dramatically less than what they were used to making before the deal was done.
Yeah, and it can really depend on the type of business. I've seen some deals where there's a transition period of a few months that's unpaid. That would be pretty normal. But if
Yeah.
someone's going to stick around for years, then there's usually a salary, or at least some kind of consulting wage or hourly rate is established when the deal is done, and some kind of limits or idea about what kind of workload might be expected of the person.
No doubt. Hey, let's talk about due diligence. That
Sure.
dreaded, that dreaded word. It's coming. We know it's coming. If we get past the LOI stage, we know due diligence is next. And sellers have, or owners who might sell someday, they've heard about it. from friends, family, someone else who's gone through it. They've read about it somewhere. They know it can be intensive. They know it can be, frankly, another part-time job added on top of everything else they're already doing. And let's face it, once due diligence begins, the buyer really is testing whether the story that the seller told them matches the reality inside the business. What have you noticed are the most common due diligence surprises that cause buyers to lose confidence?
Well, let's talk about the sellers in due diligence first, because the I have seen.
I've been calling that done diligence, by the way.
Okay. Uh, I, 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 when I'm working with someone who owns a business, I try to get a due diligence checklist in their hands early in the process with me. Like when we're having a conversation about how this is going to go down, what due diligence is going to be like, because they really have no idea. So I've actually programmed an AI due diligence checklist generator, and I will put in the name of a real world business. It will look at the location, the municipality, it'll look at zoning, it'll look at licensing for that type of business in that jurisdiction, it'll look for all the regular stuff, you know, and it'll produce this list. And the list will include things like the contract on your merchant terminal for accepting credit cards. It'll have like licensing regulation. And sometimes there's 80 or 100 things on this list. And I'll
That's pretty
give it to
granular, it
business
sounds like.
owners. I'll
Yeah.
give it to business owners and I'll say, this is what you need to have assembled before you put your business up for sale. Because if you wait until due diligence to get this together, you're going to drag this on for months. And I have had people change their exit plan when they've seen the list, where they've actually said, what's my business worth again? And what would it be like if I just liquidated or if I sold it to one of my employees? They wouldn't need all this due diligence, would
Or
they?
if I kept it
And
as long as kept it open as long as I stay alive and want to stay in it, and just like you said earlier, extracted benefit out of it along the way, kept it a lifestyle business. Yeah.
yeah, that I call that a wind down. So, you can wind down a business by intentionally shrinking its size to something more easily managed. You don't reinvest in capital equipment. You just wear the stuff out you have and then, shut down that service line when the machine's gone. And I've had people choose those different paths when they see the due diligence checklist because they just realize how onerous and difficult it will be to actually get through this process and how hard it's going to be on them to actually pull everything together in their business. And so that's one of the number one surprises. And I think when it comes to the buyers, what are some of their biggest surprises in due diligence? I have seen so many buyers discover major mistakes in businesses. And I'm not talking about somebody trying to commit fraud or misrepresent their business. I'm talking about a business owner who honestly believed everything was really great in their business. And then the buyer turns up something that shows that there's a real problem in the business that has a huge impact on value. And it's entirely a surprise to the owner.
Like
Uh,
what comes to mind might be something like unprotected IP. Hey, you're in the marketplace, you're presenting yourself as this aggregator of IP, but you don't have any contracts with the providers, the actual providers of the IP that you're relicensing and selling. I've seen a situation like that before. Key people are not under some type of non-disclosure, non-compete type of agreement. Um, your financials are a wreck. They were just passable for tax returns, but they're not GAAP. Here in the U.S. Generally accepted accounting principles. Yeah, I mean, what kind of examples do you have? The list is very, very long.
well, some of the easiest ones are just an understanding of capital equipment depreciation.
Yep.
So in the world of business brokers, you add back amortization and depreciation. And if you ask a business broker why, they will say because it's a non-cash expense. And in the United States in particular, depreciation on a P&L doesn't really mean anything because there's all these like rules for bonus depreciation and accelerated depreciation, which are tax incentives to get businesses to reinvest. So the depreciation number you see on a P&L really doesn't relate to things wearing out, which is what the accountants had wanted originally when they created this idea. Like, let's measure how stuff wears out and we'll call it depreciation. And so when you're buying a business, what you have to do is you add back the depreciation and amortization, true, but then you have to create an allowance for something called capex, capital
Yep.
expenditures. And so sometimes people will have a business with a lot of capital equipment, big expensive machines, trucks, for example, payloaders, that kind of stuff. And they will have a really great EBITDA or seller's discretionary earnings because the depreciation has been added back. But when you start to look at the fleet of equipment and realize, hey, I need to buy a loader or a highway tractor every year to replace this fleet on a continuous basis, well, now we're subtracting what? 600, 7, $800,000 a year from our cash flow to buy a new truck.
What you don't want to tell a sophisticated buyer is, hey, these are the last assets you'll ever want to own or need to own in this business. And that's just not the case.
Right. So I've seen business owners go to the wrong broker who applies a multiple to EBITDA, tells them that their business is worth a certain amount of money, and then the right buyer comes along who understands this stuff and says, no, 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 no. It costs money to buy trucks. And we're going to have to do it. And all of a sudden, the business that is, supposedly worth $2 million is really worth 350 grand. That's the kind of thing that happens all the time. And the smarter and more sophisticated the buyer, the earlier it happens. And so for some sellers in that situation, they'll send out a sim, or the broker will send out a sim to a sophisticated buyer who will spot it right away and just won't make an offer. You just won't hear from that buyer again because they'll know that you don't know, right? The problem is when you make mistakes like that is you run into buyers who don't know, and the buyers might actually make an offer. And then the buyer gets into due diligence and the buyer starts asking for a bunch of stuff. Then you start going through everything. And then at some point, the bank asks the buyer for a cash flow forecast. And then someone points out that the equipment needs to be replaced. And now you're 4 months into it before they realize the problem. And then they come back and say, we need to amend our $2 million offer to 350 grand.
The whole time, the seller has, you hope the buyer abides by the NDA, but the whole time the seller has been relinquishing and giving up sensitive information. And were it not for this one glaring preventable mistake, they wouldn't have had to do all that. They wouldn't have had to make all these
Yeah.
disclosures, and they would have gotten in front of the right buyers. They wouldn't have disclosed the wrong information to the wrong buyers.
Yep. And this stuff happens all the time. Like
Yeah.
I get asked sometimes, what qualifications do you have to be a business broker? And I'm not trying to be facetious, but the number one qualification to be a business broker is a willingness to work for free because it is a 100% commission compensated role. So business brokerage offices need people willing to work for free to put in the work for a year or more to get listings and actually see deals through to close to get paid their first commission. And so there's a lot of really smart business people out there and people with finance backgrounds and accounting backgrounds who understand numbers and understand business, but they tend not to be willing to work for free. And so what ends up happening is certain people get drawn into the industry because they see what they perceive as high commission rates for selling these businesses, 10, 12%. And so it attracts people into the industry, and you get this nonstop revolving door of people coming through these offices. A lot of long-time established business brokerage firms will have a couple of long-time lifer kind of people, and
Yep.
then a pack of people that are just turning over every 6, 8 months.
Floaters.
And it's really difficult for people to be able to actually get the level of professional sophistication required to do a good job, especially in the bottom end of the market. Those mid-market M&A firms, they're closing deals for people and getting hundreds of thousands of dollars in fees, and they can float themselves over the lean times with that money. But in small Main Street and lower mid-market brokerages, it is difficult. And this is another reason why you see a lot of retired people kind of do it because they've got a pension or something, and they helps to buy the macaroni between deal closings.
Yep. I've noticed sometimes when I get pushback from a seller, why should I pay you, X percent blended percentage over the uh, the potential deal size of doing this transaction? I say, well, how much do you think it costs to build the New York Stock Exchange or the Nasdaq? And I'll get a kind of a puzzled look or response. Well, I don't know. It's got to be a lot. And I say, it's probably a lot. It's probably in the hundreds of millions, if not billions of dollars to build each of those exchanges. And what's happening there is the exchange of information between buyers and sellers. That's at the end of the day, that's what the essential role of a market is. Well, that's what we're doing here for you. We're building a market for your business, a highly illiquid asset where no market previously exists. And I do take a fair amount of pride and do a fair amount of work in transactions and help owners understand this is what you're going to be facing. I have a fortunately, unfortunately, it's not 100% success rate when taking companies to market of getting them sold. So far, it's 83%, but that's a little bit better than the national average of 20%.
Mm.
Uh,
I
so
think your analogy is great. I usually when I was a business broker, I used to point to the world of real estate, and I used to say, look, when you buy or sell a house, there is a real estate agent finding the buyer. There is an appraiser appraising the house at some point, and there's also a mortgage broker arranging the financing. And when I was a business broker, I was finding the buyer, I was evaluating the business and showing the seller what it could reasonably sell for. So I was kind of doing the appraiser's job. And I was working with the buyer to arrange the financing and make the presentation to the lender as to why they should do the deal to make the acquisition loan. So I would draw the comparison to the world of real estate and say, I'm doing these three different jobs together. And
yeah,
that's why the commission is what I'm charging. Today, when I work with sellers, I have a different business model than you do, Bob. I have broken it down into a series of consulting tasks, and I charge a flat fee for each task. And so the reason I do it that way is because I've been burned so badly in the world of business brokerage. You talk about the success rate of brokers. There are so many files that I had on my desk when I was a business broker that never ended up closing, but they took just as much time to work on as any of the other ones.
yep,
And so I have a real bad taste in my mouth for contingency revenue. Like if you have a good successful business and you want my help to sell it, I will do it, but you will pay me like any other consultant. And so I like to say that I borrowed the business model of accountants and attorneys. Because if you go to an attorney and say I need you to do this legal work, they're going to do the work and bill you. And that's the way I operate as well.
yep. Well said. Hey, let's talk about the control illusion. This illusion that a lot of owners who might someday sell, that they're in control of a lot of factors within their business, and unfortunately, they feel they're in control of factors outside of their business. A pretty recurring theme here on these podcasts and in conversations that I have is that owners often feel in control until the market starts testing the business. From where you sit, where do you see owners start losing control during the sale process because they just weren't prepared early enough or by the right
Yeah,
people?
I think it particularly happens when they deal with somebody who is out of their league. So, there are certain industries in particular, like right now, HVAC is a big one where these smart people are doing big investments in rolling up smaller businesses into bigger and bigger outfits. And when I talked earlier about the seller notes, I said that the sellers had an advantage because the buyers didn't know everything about the business. And that's where the seller note helped to balance things out. Well, where the buyer does not have that disadvantage is if the buyer already owns several businesses in your industry already.
Yep.
That buyer doesn't need your help. That buyer probably looks at your business and points out all the things they know they can do better than you. And so they don't need to have a positive, happy seller at the end of the transaction willing to help them out and coach them and guide them. And so if you think about that, it makes it more like selling a bicycle on Facebook Marketplace. Like if I'm going to go buy a used bicycle on Facebook Marketplace, I drive over to some stranger's house, I point out every nick and scratch and try to get the guy to reduce the price by 20 bucks. I pay them and I take the bicycle. It's a transaction, it's done. I don't care if
Yep.
he likes me or not afterwards. I can't buy a business that way if I'm an individual buyer who needs the seller's help. I wouldn't be able to buy a bicycle in that fashion if I needed the person's help to teach me how to ride the bike. Right. So, because of that, what was I able to do? I was able to play games with them. I was able to try to, get the price reduced. And so we see the same kind of things with some of the professional buyer groups out there where they will come in and they will outbid everybody else. They'll outbid the individual buyer and offer a price that doesn't seem to make sense. And then they'll tell you how great your business is, and then they'll start their due diligence process, and then they'll start to drag things out and they'll make you work harder and harder through that due diligence process. And they will determine when you're getting kind of tired of it all. And they'll come back and they'll say, well, these are all the things we found. And so unfortunately, we're going to have to amend our price and they're going to change the price dramatically. And then you have to decide, do I want to go back to the process and start over again after I've already invested months and months with these people? Or do I just want to tap out and leave? Remember earlier we said that there's 5 personal motivations for why people sell a small business: burnout, boredom, and fatigue, divorce, poor health, the need to relocate, and retirement. If you want to retire, it's actually the least motivating thing, because if most people that are 65 that just want to retire, they can work till 67. It's not a problem. But if one of those other 4 things is motivating you and you've already invested several months with these people, and now you're faced with the idea of going back to the well for a new buyer and it could take another year, guess what? They've got all the leverage now. And you've let them have the leverage through getting into bed with somebody who is in a different league than you. And so I honestly see that as being one of the most common mistakes that sellers make. The next one would probably be hiring the wrong advisor who doesn't really know
Yeah.
what they're
Yeah.
doing. I say there's 2 kinds of business brokers. There's the shopkeeper and then there's the dentists. I put them in those 2 buckets. If you think of walking into a retail store, you're greeted with a smile. Somebody, asks you what you want. They lead you around the store. They give you everything you want. They want to make you smile. They want to make you happy. Those kinds of business brokers are the ones that tell you your business is worth the most, that they can get the top dollar. You won't have to do any seller financing. Everything's going to be okay. That's not the kind of business broker you want. You want the dentist. If you go into the dentist's office and say, my tooth hurts, the dentist will look in your mouth, and let's say you need a you've got a cavity, they're going to say you need a filling. And if you say, no, 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 I don't like the drill, can you just polish them up? The dentist is going to say, no, I can't polish it up. You need to have your cavity drilled. And that's all I'm going to do for you. So open up or get out. That's the kind of business broker you want as a business owner. You want someone who's going to be forthright, tell you the truth, properly set your expectations, and tell you the pain that you're about to go through so that you know what you're getting into. So,
Yeah.
yeah, I get
Yeah.
excited about this stuff sometimes, Bob.
I don't make a lot of friends among small business owners when I tell them, in a shorter period of time as I can, some harsh realities. On
Yeah,
the other end of the spectrum, just last week, I had to send a company upmarket from me to a securities licensed large middle market firm. I sent them a transaction which I estimate is going to be, in excess of $2 billion, billion with a B.
holy cow.
I can't, I'm not that guy, not yet, at least, but maybe we'll get there someday. But for now, that business owner and his partner are better served with a mid-tier firm.
Of course.
Hey, let's go a little further here. Owner psychology
Yeah.
and deal fatigue, because you kind of touched on it. I too see that grinding process happen often. We try to get ahead of it. We try to warn sellers, you're going to go through it, especially by sophisticated buyers. Selling a business is not just a technical process. I mean, it becomes emotional, and I hit that pretty hard in the book. The book is, I've been told, is just emotion from cover to cover. It becomes emotional because the owner is dealing with money and identity, trust, risk, employees, family, and uncertainty, all this stuff hitting them at once. So, where does owner psychology most often interfere with good decision making during a sale? We know it's going to play a role, but what kind of role?
I think one of the big problems is what I call golden goose syndrome. So if you remember the golden goose, it laid golden eggs, right? And so the idea is that if the business is a golden goose, everybody wants it. And so today there are a lot of people out there on these platforms, and a lot of these online platforms and business brokers' websites are designed to create inquiries from buyers. I mean, obviously, right? That's what a broker does. They try to help bring buyers and sellers together. And so when you put a business up for sale and you get 100 inquiries in the first 3 days, it can lead to the impression that what you have is extremely valuable and you have the pick of the litter of who is going to buy it and who you can sell it to. And one of the traps that people fall into is that they fail to properly filter. Now, if you're using some kind of intermediary, they should be the
I,
ones
I
helping to
definitely agree
filter.
with that. Yep.
They should be the ones helping to filter. When I work with sellers and we put something up for sale on one of those online marketplaces, we get a ton of inquiries depending on the type of the business. but we are lucky if 15% of the people that inquire actually end up having a conversation with us.
Yep.
Because when it's very easy to inquire, you just click a button, hey, send me more information about this. And a lot of sellers or those shopkeeper brokers make the mistake of firing back actual information. What we do is we send an NDA and a questionnaire
Yep.
that they have to fill in. And they have to fill in the questionnaire to the satisfaction of the business owner in order for us to reply in any way. And it is mind boggling how many people get that from us and just don't do anything.
Yep. The serious
Because they,
ones, the committed ones, they'll send it back.
yeah,
Yep.
the people who are serious good fit buyers who say, yes, that's the industry I've been waiting for and that I want to learn more about that, they're going to fill it in with thoughtful, detailed answers and they're going to send that back to us.
Yep.
And one of the big important factors that I think is required when you're meeting with potential business buyers is to get them to demonstrate their capability. Right now, there are, last count,
Kind kind of like reverse due diligence. You're vetting the buyer as much as the buyer is you.
yeah, you're vetting the buyer because right now on social media, as far as the last count goes, I think there are 22 different people online selling these courses on how to buy a business with no money.
Yep. I've seen enormous number of posts on LinkedIn.
Yeah, every month there are another 100 people who think that they can buy your business even though they're broke. And you can't buy a business when you're broke. You've got all kinds of professional fees. You have to make some kind of down payment. And often, depending on how the transaction is structured, like if it's an asset sale, the buyer may also need to put in working capital, which is outside of the transaction with the seller. So you can't buy a business when you're broke. But all of these people are out there sending off inquiries on businesses. And this is why you need to go back to that exercise I was talking about earlier, where you have to figure out who is the buyer going to be, what's their likely resources, what kind of down payment they're likely going to make, what will their loan be, can they afford to pay the loan? Because once you can imagine that transaction and the deal structure the way it likely will pan out, well, guess what? Now we know how much money the buyer needs in liquid funds.
Mm.
So it's very easy then to say, if I'm selling my business and I know my buyer is going to need to put 100,000 down and have another 70,000 of liquid money for the other things he needs, now I can say in my posting, it is anticipated the buyer will have $120,000 of liquid non-debt funds that they can put into this deal. So when you get the inquiry, you say, what can you show me that shows me you have $120,000 available? And then you're going to get radio silence. You're going to get song and dance. Very few people are going to fire over, a PDF of a
Personal
stock
balance
brokerage
sheet.
account with the
Yeah.
account number blacked out or whatever,
Yeah.
right? With their name on it. But that's the person you want.
Yep.
They've qualified themselves. They've shown that they can actually make the down payment. And it seems like very few people are willing to do that. The other thing you have to think about, especially if your business is going to be bought by someone who's going to take over your job day to day, is you've got to treat it like a hiring activity. Like
I
you
like
are
that. I like that a lot.
hiring your successor.
Yep.
And so the bank is going to want to make sure that this person actually has what it takes to run your business. So asking the buyer for their professional resume is also something that you want to do because you want to see how their background actually applies to what you do in your business. You know, if if the person has experience being a mid-level manager in a similar company or an analogous industry, yeah, probably they have the skills it takes to run your business, right? But if the person doesn't have any kind of skills like that at all, if they deliver mail for the postal service and you run a $10 million a year sales company, chances are the bank is never going to give them a loan. So so you want to make sure that they are the right successor for you and they have the right financial backing in order to make the deal happen. And and that they have to be able to prove these things. There's another whole community online called search funders. And what search funders do is they try to arrange for investors to help with their down payment. And often they can't get funds committed from these investors until they have a deal at hand. And they will tell sellers that they have money to buy the business, and then they'll run to the investors to try to get these deals put together. So it depends on how much patience you want to have. But some of these search funders are honest with their situation and their position, and some of them are dishonest. So again, you have to decide what kind of buyer are you willing to deal with and what sort of scenario, situations, delays, et cetera, that you're willing to live through. If you have a very sort of cookie cutter kind of business that's quite common, and there are a lot of people out there potentially looking for a business like yours, you don't need to accommodate these sort of extraneous or outlandish kind of delays or requests.
Yeah.
If you've got a gas station corner store, there's 101 people out there looking for that business right now that will make an offer. If your business is a little more special, you know, if you are the only engineering firm in a small town in a very rural area and you need to find a licensed engineer who's willing to live in a rural area to buy your business, then you're going to have to maybe stretch yourself a little bit to accommodate someone who's the right candidate with the right skills and has that engineering license. And maybe they need to work a little bit to try to get that down payment together because, quite frankly, you're just not going to have as many buyers in your pool willing to go to where you are to take over that business.
I think also that reverse due diligence concept can apply upmarket, to businesses larger than Main Street as well.
Mm.
I mean, different kinds of reverse due diligence. So if you're a good candidate for a private equity backed firm or a strategic buyer, in this case of a strategic, there may be a lot of publicly available data about their activity at making acquisitions or acquisitions within the industry itself. In the case of a PE backed buyer, you can look at their funds, their track records. Is this a category that they've been in for a long time that they want to stay in, that they're putting a lot of investor capital into? So yeah, they're small deals, medium-sized deals, and above. We deserve the right as sellers to dig into the buyer's ability and willingness to do the deal as well.
I think so. Yeah.
Hey, David, as we round third and head toward home, we've got a section here we call the rapid fire questions. The audience, some people in the audience like this section. So here we go. Quickly, the biggest myth about selling a small business.
I think it's the one I mentioned that my friend Mike always says is that people believe their business can be sold when they want to, and it's not true. Businesses are sold when the business is ready to be transferred.
I like that. I'll remember that. Yeah. Hey, number two, most common reason deals fall apart.
People waste time because they're afraid to make the next step. And so this is where buyers get bogged down asking questions continuously when they should be making an offer to find out if what they're offering is in the ballpark of what the seller might be willing to accept.
Good one. Good one. All right. Next, the most overlooked value killer.
It's whether or not there's something special about the seller's career and experience that is particularly impossible to document or pass on. So, real professional judgment kind of role within a business, really hard for that kind of
Yep.
business to change hands.
Yep. That kind of leads into this one. What makes a buyer trust a seller faster?
What makes a buyer trust a seller faster is the willingness to make a deal and to be there for support. And the way that you communicate that is by saying you are willing to look at a deal structure that involves some seller financing.
And finally, what makes a buyer walk away the fastest? Oh, this should be a good one.
But it's that golden goose syndrome.
Yeah.
So when a seller believes they've got the most valuable thing in the world and everybody wants it, it changes the way they behave to the buyers. And so you get these really good qualified buyers who send in inquiries, they send an email, they ask questions, they want to have a talk, they want to meet the seller, and they get rebuffed, they get ignored, they get responses a week and a half later, and they just get annoyed and upset with the process. And they say, how could I ever do business with a person who treats me so disrespectfully? Will never be able to get along because of how they behaved. And I draw the analogy all the time to the world of dating. If you're a man and you want to find a wife, if you try talking to 10 different women at the same time and they're all sending you messages and stuff, you just can't keep up with all the conversations, and they're all going to realize, hey, this person doesn't really pay attention to me or have time for me. And we are people. We do business with other people. We have relationships between us. We have a strong sense of understanding that gut reaction to someone, is this person being forthright, honest? Are they treating me fairly? Is there something fishy going on? People feel this face to face, they feel it over the
Yep.
phone, and they feel it through emails too. So if somebody believes that something just isn't right, and I'm trying to buy a business, I'm going to put hundreds of thousands of dollars down and borrow millions at the bank to give to you, and something doesn't feel right. I tell people all the time, if your gut's not in it, like, you got to walk. There's
Yep.
something wrong.
No, no, that's well said. We'll wrapping up here. Most owners listening now or later to this podcast or maybe watching it, they're not interested in selling tomorrow necessarily, which means they still have time to make the business more understandable to that future buyer, as we talked about, more financeable by the provider of that future capital, and frankly, more transferable to the buyer. If an owner expects to sell in the next 3 to 5 years, we like to ask this question here toward the end. What's the first practical step they should take this quarter?
Get your business valued. So call Bob, call me. I did a presentation in front of a room full of financial planners at a big financial planning outfit. They realized that they had a problem because they were meeting people who were 35, 40 years old, et cetera, business owners. And the financial planners were trying to create these financial plans to ensure retirement. And the financial planners were asking people, "Oh, are you going to sell your business one day?" And people were saying, "Yep." And they said, "Well, what are you going to sell it for?" $1 million when I'm 65. And these financial planners were actually putting this into the plan.
Just plug it in. Thank you very much. No
Plug
discernment. I'm just
in
going to put it
$1
into the
million
model.
dollar windfall on your 65th birthday, and they would plug it in. And what was happening was people were getting into their 60s and their plan looked great. And then they would realize, well, wait a minute, my business isn't worth $1 million, or I can't sell my business, or nobody wants to buy it, or now I'm learning that, et cetera. And all of a sudden now the plan isn't working. So they had me come in to talk with them about some sort of general rules of thumb about what to look for in a business and get some idea of whether or not these seller expectations were realistic or not. And so getting your business valued even as early as 10 years before you plan to sell it, I think is valuable because it's going to create a scorecard for you and it's going to give you an idea of what it's worth. I have many times in my career run into people who have made huge investments in a business. They bought a $500,000 piece of machinery or something like this. And then they decide they want to sell, and I'll show them their business is worth far less than the value of its assets. And they'll be like, "But how can that be? I put in, all this investment to buy this machine." And I'm like, "Yeah, you never should have. Like the cash flow of your business never warranted that investment. I don't know why you
Mm.
bought that machine." If they had that information, if they had known what their business was worth beforehand, they would have changed their entire exit strategy and plan and realized, hey, I'm not going to be selling my business one day. I'm going to be winding it down or something or something at some point, right? You need this information in order to be able to make decisions. And so I've actually got a couple dozen clients who have valued their business, and every 2 years or 3 years, they come to me with new financial statements, and we just update the
Yep.
report. We show them how things have changed, et cetera. And it helps to keep them on track and gives them information they need to make decisions. And so that would be the number one thing I would say is get your business valued because most of the time business owners do not have any idea what their business is worth.
I've heard the
Um,
stats are as low as 4 or 5% at any given
yeah.
time actually do what that tradable range of values might look like. Amazing.
Well,
Th-
and,
That
and,
would
and
be like
even
that would
well,
be
well,
like them contributing for 25, 30 years in a corporate retirement plan if they had gone that route instead of business ownership. And they don't get regular monthly brokerage statements showing what's the
mhm,
value of what's in there until 6 months away from retirement. That's what these business owners are doing to themselves.
yeah.
Go into these transactions, not to your point, not having value benchmarked early and not having it re-upped every so often.
Well, I'll tell you a scenario that unfortunately happens quite often that really catches business owners off guard. Um, you have a business and it has a lot of capital equipment, trucks, machinery, that kind of thing. And so the business owner is operating it, they're making money. And because they've been successful for a long time, they don't have a lot of debt. And then they want to sell the business. And I do an evaluation. And I say, hey, your business might sell for about $650,000 to $700,000. And then they look at me and go, Well, that's crazy. I own $1 million worth of equipment. And so then my next question will be, is there anything here you don't use much that you could sell and still do the same level of trade that you're doing today? And if the answer is yes, then I recommend that they sell those pieces of equipment independently, and then their business should still hold the same value. But sometimes the answer is no. And then they'll automatically say, why would I sell my business as a going concern? And what's happening is they've invested money in equipment, but they're not yielding enough of a cash flow from that equipment to actually warrant the investment in their business, because
Mm.
the risks of their industry demand a rate of return that is higher than what they're actually yielding. And so then what they'll say typically is, well, then I just won't sell as a going concern. I'll just sell off the equipment and liquidate. But here's the problem is that equipment might be worth $1 million in fair market value in continued use in their present business. But the minute you shut down the business and decide to say, I'm going to sell it all, now you're looking at an orderly liquidation value scenario. Unless you're willing to park it all in your front yard at your house and sell it off slowly over the course of the next 2 years to get the right price for everything, which most people are not. And so the orderly liquidation value of that $1 million of equipment might be 600 grand. And I'm
For
told them their
for the
business is
same
worth seven.
reason, for the same reason the buyer of the business doesn't like to pay the asking price. They're just not comfortable with the track record. They don't, in the case of a piece of equipment, they don't understand its use, its history, how often has it been repaired, where is it
Well,
broken down the most. To
if you
them, it's
close,
worth a lot less because of that risk factor.
if you close the business and say, I want to close the business and sell all the equipment within 30 days to liquidate and get my money out, what you have to do is you have to sell it at orderly liquidation value in order to bring people into the marketplace to buy the equipment who aren't necessarily shopping for that kind of equipment, right? And this is how a lot of these businesses end up with surplus equipment is somebody went out of business and they went to an auction and got a quote unquote good deal on something. They paid 100 grand for something that should be worth 500,000, and they're very proud of themselves. But what they're doing is they're investing more and more in these fixed assets. And if they're not yielding a sufficient rate of return out of them, then they're not actually growing the value. They're not creating goodwill in their business. And so these people will get trapped where they if they want to exit in an expedient fashion, it actually makes more sense to sell at the cash flow value, which is going to be less than the fair market value of the assets, because maybe that value is more than the orderly liquidation value.
Mm.
And they get to preserve the jobs within the business, which could be of value to them. So that kind of scenario, you can better manage it if you know 5 years earlier, because then you're going to look for opportunities to sell pieces of equipment. If you hear the dealer saying, "Oh yeah, a lot of people are looking for this kind of thing," you'd be like, "Oh well, I've got one. If you can get me a good price, I'll let it go." And you can actually ease yourself out of it in a more lucrative fashion than, to your point, if you wait until 6 months before you open the envelope and figure out what it's all worth. The the propensity, I think, among a lot of business owners is just to believe that because they benefit to a great extent in the business they built, that other people are going to value it based on the benefit they receive. They forget that the buyers are going to apply a bunch of leverage. And I think that's the big takeaway lesson that everyone should take is that the business you sell to someone is not the business they end up with, because they end up with usually a lot of debt and they have to make those payments, and it's never as lucrative for them as it is for you. And so their point of view looking at your business is drastically different. And nobody's going to pay all cash for a business. If you have $1 million business and a buyer has $1 million, they're not going to spend $1 million on your business. They're trying to figure out how to turn their $1 million into buying a $5 million business. The person who buys $1 million value business is a person who's got 200 grand, 250 grand. They're trying to leverage that money into buying the $1 million business.
You got it. Great way to wrap up. David, this has been awesome. Really appreciate you bringing a blend of seller and buyer perspectives to the conversation here today. Hey, where can folks get a hold of you to hear more about the good work you do?
Sure. So my name is David C. Barnett. If you type that into YouTube or any podcast app, you're going to find my podcast. I've been doing podcasts for 12 years, talking about buying, selling, financing, and managing small and medium-sized businesses. So you can give me a follow there. And if you go to davidcbarnett.com, that will lead you through to my blog site, which is where I post everything. And I've got online courses and I do consulting work with people who want to buy, sell, value businesses or machinery and equipment. And I'm here to talk with you about whatever project you're working on and see if I can help out.
Excellent. You'll be a valuable resource to many people who are listening. Appreciate your time. Hey, that's a wrap for today's episode of the Exit Teams podcast. Thanks to my guest, David C. Barnett, for sharing his insights. So if you're thinking about buying a company and you want to be better prepared when you start, I suggest you reach out to David, see how he can help. If you're a business owner thinking about your next chapter, now's the time to start building your advisory team. You can learn more in my book, Exit Teams: Build a Team of Advisors for Your Business Sale to Get a Higher Price. Available on Amazon. And don't forget to visit exitteams.com for free resources, tools, and insights that can help you prepare for a successful exit. Until next time, build your team, sell smart, and take control of your future.